Hello, 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 and welcome back to Freedom Ain't Free. Another episode that we're sharing with you guys this morning. And what we're going to be talking about today is I died and I made my family rich. How life insurance strategies create financial freedom for you as well as your family. My name is Joel Huey. I'm the principal at ARC Financial Strategies. This is the Freedom Ain't Free channel where we're here to share with you the wisdom, the knowledge, and the understanding of all the financial tools that are available to you to get yourself to a state that we like to call financial freedom. At ARC Financial Strategies, we believe predicting the rain doesn't count. Building the ark does. We work with a group of investors we refer to as Henrys, high earners, not rich yet. Our goal at our financial strategies is to help our clients to develop financial freedom. We define financial freedom in the form of income. Our goal is to get our clients to $120,000 to $160,000 a year in income coming from their investable assets. In order to do that, we need to help them create a portfolio of $2 million. Our goal is to give you time to pursue the things that you want to pursue in life, your passions, the purposes that God created you for, where you want to focus your time and attention so you can spend more time with your family, so you can spend more time working on the things that are important to you and break yourself free from the rat race. We work with a group of people who want to own their time back, want to buy their life back, and get themselves completely financially free. But in today's video, we're going to be talking about how life insurance strategies create financial freedom. We're going to walk you through all of the different pieces of that puzzle and share with you how to utilize this tool to create financial freedom for yourself. Again, my name is Joel Huey. I'm the principal at ARC Financial Strategies. I have an insurance license, an annuity license, and a long-term care license. In addition to that, I have a FINRA Series SIE, a Series 6, a Series 63, a Series 65, a Series 7, and a Series 24 principals license. I manage millions of dollars of other people's money, and our goal on the Freedom Ain't Free channel is to give you the wisdom, knowledge, and understanding you need to utilize all of these tools. Today, we're talking about the tool that's called life insurance, right? So what is a life insurance contract? A life insurance contract between an insurance company and a policyholder where the insurer agrees to pay a lump sum of money to named beneficiaries upon the insured person's death in exchange for regular premium payments. Its primary purpose is to provide financial security for the policyholder's loved ones to cover expenses like funeral costs, debts, and ongoing living expenses after the insured has passed away. That is the primary function of a life insurance contract. It's between you, the insured, and the insurance company, right? In most instances, you are the insured as well as the owner, but those can be two different people, right? So you could take out a policy on your spouse, you would be the owner, your spouse would be the insured. You could take out a policy on your children, you would be the owner, your children would be the insured. The contract is between the owner and the insurance company. But in most cases, the owner and the insured are the same person, thus the contract being between them and the insurance company. The insurance company is guaranteeing in the contract to pay out X amount of dollars to the people you name as a beneficiary in exchange for regular premium payments from you. You make a premium payment to the insurance company. If you die, the insurance company is going to pay out that face amount or that death benefit to whoever you have named or however many people you have named as beneficiaries to receive those dollars. That is the contract, and that's the primary purpose behind the contract. There are two different types of life insurance, right? Which is why we have to first understand the tool, and then we can understand all of the features of the tool, and then we can understand how we want to work this into our portfolio. Because here at the Freedom Ain't Free channel, we believe that you need to have the wisdom, knowledge, and understanding of how every tool works, and that you need to have every tool that fits in your portfolio. There's no such thing as one tool being the end all to get you where you want to go in building out your $2 million portfolio. We're going to need to use them all in order to get us to where we want to be. So, two types of life insurance. First type of life insurance contract is a term insurance contract. In a term insurance contract, the insurance company is guaranteeing to pay out that death benefit if you die within that term period, as long as you make the premium payments during the term period. You might get a 5-year term, a 10-year term, a 15-year term, a 20-year term, a 30-year term, whatever amount of time you choose. Now, at the end of that period, the policy does not end. Most people think that is the case, but that's not actually the case. The insurance company is not saying that they won't insure you past the term. They're saying that they won't insure you for that price, right? It's the price that changes at the end of the term. So if I sign up, if I'm 35 years old and I sign up for a 20-year term, the insurance company says that my premiums will stay the same from age 35 to age 55. If I want to keep that policy at age 56, I've got to pay an additional, a different premium to keep that policy in force from age 56 on, right? Now, here's what happens. The price changes so dramatically that most people just cancel those policies at that point. But you can continue to make those premium payments if it makes financial sense. As an example, if you took out $1 million policy, and this is just an example, right? You took out $1 million policy, and that policy cost you, let's say it was $1,000 a year at age 35, right? You would pay $1,000 every year for the next 20 years. If you died, the insurance company would give your family the $1 million. If you lived, nothing would happen, right? At 20 years later, you're now 56 years old. The insurance company will come back and say, if you want to keep this $1 million in coverage, we want $10,000 a year, not $1,000 a year. At that point, you have to decide, is it worth the exchange? If I give them $10,000 and I die, they'll give my family $1 million. Well, that's still a pretty good exchange, right? $10,000 for $1 million, right? So you just have to do the math to determine. I like to think of term insurance when you think about that inside of your portfolio is if I don't have the $2 million that I need for financial freedom and I died, my family still needs the $2 million in order to be financially free. Here's where term insurance comes into play, right? I can buy $2 million worth of term insurance for the 20 years that it's going to take me to accumulate the $2 million, or the 10 years that it's going to take me, or the 5 years it's going to take me. Whatever amount of time it's going to take me to accumulate that $2 million, I want to have term insurance to cover me during that window of time. If I die, my family is still financially free. If I live, I've created the $2 million. I no longer need the term insurance policy. If you need to know how much money you need to save every single solitary month in order for you to develop that $2 million portfolio in the time frame with which you want to develop it, here at ARC Financial Strategies, we call that your freedom number, and you can simply schedule an appointment with one of our advisors. 20 minutes, 30 minutes, we'll get you your freedom number and tell you for free exactly how much money you need to save on an annual basis in order for you to get free in the time frame that you want to be free in. Then you'll know how much term insurance you need and how long you need to keep that term in place in order to make sure that your family is going to have financial freedom. The second type of life insurance contract there is a permanent life insurance contract. Permanent is the category, and then there are various types of permanent life insurance policies. You could have a whole life permanent life insurance policy. You could have a universal life permanent life insurance policy. You could have an IUL, an index universal life permanent life insurance policy. You could have a VUL, variable universal life permanent life insurance policies. Those are 4 different types of permanent policies, but they're all permanent. What makes them permanent? The premium that you pay in those strategies to guarantee the death benefit is designed to permanently never change. If the insurance company says, give us $1,000 a year for this $1 million worth of coverage, you will pay $1,000 a year for $1 million worth of coverage for as long as you live, right? Typically, permanent strategies are payable to age 100. Some companies have extended that out because people are living longer to age 121, but typically a permanent strategy is payable to age 100. There are shorter strategies. We'll do a whole video about that. Today, we're just talking about the contract in general, right? So a permanent strategy is designed to make sure that I'm going to pass on this asset to the next generation, and I will lock in the premium, and the premium will stay the same for the rest of my life. It's guaranteed never to change. So as long as I make that premium payment, or my family makes that premium payment, they will receive that death benefit when I die. Here's why that's important. If I want to pass on assets to the next generation or the generation, right? God tells us that we ought to take care of our children's children. I can utilize the leverage in a life insurance strategy, have a fixed premium for my entire life, and I can guarantee that my family will have the $2 million necessary for them to be financially free. It only takes one pioneer in a family to ensure that they have created this base, this floor, right? This financial freedom, so your family doesn't have to be subjected to the rat race here in America that's designed to keep you working for the rest of your life. Freedom ain't free, ladies and gentlemen. It's going to cost you something. But if you learn these strategies and you plug them in, put them in place, you put yourself in a position to break free and to create so your family's free forever. So I can utilize a permanent life insurance strategy to create a part of my portfolio that's guaranteed to deliver to my family. The only thing I have to do is die, which is why this video says, I died and made my family rich. I created a guaranteed system for my family to make sure that they were going to have this base platform to build and grow wealth for the next generation. Now, I can use the various different types of permanent strategies for whatever part of that strategy makes sense to me. So we'll spend a few minutes going through the different strategies and how you can utilize them to create financial freedom for yourself and then create that legacy for your family. So with the term policy, I like to refer to that as a golden toaster strategy, right? Golden toaster. Here's how this works. If you had a toaster and that toaster spit out $50,000 a year every single solitary year, and you didn't have to do anything, right? You just plugged it up one time, and the toaster put out that $50,000 a year every year. How much would you insure that toaster for? Would you want 20 years of income, 30 years of income, 40 years of income? How much would you insure that toaster for to ensure that if that toaster broke, that toaster was damaged, if it could no longer produce that $50,000, I want this $50,000 to continue? Well, I want you to understand that you are the golden toaster for your family. If you're if you're creating $50,000 a year in income, your family's not going to work with you. They're not dealing with your boss. They're not dealing with your coworkers. They're not dealing with your customers, right? They're not in meetings. They're not doing reports, but they're living off of that $50,000 that you're bringing home to support the family. So if you are no longer here, if you have died, your family is still in need of that $50,000. Term insurance will replace the income that you were planning to earn to build that portfolio. That's the golden toaster strategy. On the permanent side, right? Whole life insurance. A whole life policy is designed to give you a guaranteed rate of return. The insurance company is going to say to you, I'm going to pay you 2.5% cash on the cash value inside of your policy every single solitary year. Here's why that's a good thing, even though there are pundits out there that would tell you not. Well, if you have money sitting in a regular savings account, what type of return is your regular savings account giving you, right? For the average person with the average amount of money in a savings account, you're getting less than 1%. If you had cash sitting inside a life insurance policy, you would get 2.5%, right? So that's your money growing, easily accessible. You can get the money out of your policy within a couple of days. In addition to that, a mutual insurance company on a whole life platform is going to give you a dividend, which is your portion of the profits that the company makes. So they may add another 2.5%, another 3% on top of the 2.5% that you were getting every single solitary year that they pay a dividend. Most mutual companies have been paying dividends for well over 100 years. So understanding that I'm getting this dividend in addition to the guarantee inside of this strategy, and I can keep that premium payment the same all the way up until I'm age 100, right? Now, I have access to that cash value. If I need that cash value for an emergency, if I need that cash value for an investment opportunity, if I need that cash value for anything, I have access to it. In addition to that, I can take the gains off of that cash value every year myself personally and use that money for whatever I want. Supplementing my retirement, using that as to create income for myself. That now my insurance policy is producing a check in income for me every single solitary year, right? That's one of the strategies you utilize to get you to that $160,000 a year in guaranteed income coming in for you every year. You can also use an index universal life strategy. So an IUL strategy is I make premium payments to the insurance company. The insurance company takes a portion of those premium payments and buys options within an index. So it could be an S&P 500 index, a Russell 1000 index. There are various different indexes. The insurance company buys options within that index. When they make a profit from those options, they return a portion of that profit back to you. Your money's never at risk. Your money's not actually in the market, and therefore I can't lose money. Great part about this strategy, I have an opportunity to earn a rate of return up to what's referred to as the cap rate. So the insurance company might say, we'll give you 10%, right? Anything over that 10%, they get to keep, right? But I can't lose money. So if the insurance companies bet and they bet wrong, I just didn't get a gain that year, but I didn't lose, right? So the whole life policy, I'm guaranteed to 2.5%. The insurance company makes a profit, I get the dividend. The IUL, if the insurance company option strategies work out, I get up to the cap rate, or in this case, I'm saying the cap rate's 10%. I get up to 10% that year, right? So I would have gained more in the IUL strategy without taking on any additional risk. I can get a greater return than I could in the whole life strategy. And this is a way for me to accumulate more inside of my policy. So when I get my policy cash value built up to a certain level, now that gain I can take out every year, and that's going to be part of my $160,000 a year worth of income without taking on any risk. The third type or piece of the puzzle you have an option for is a VUL. It's a variable universal life strategy. That's where the insurance company is taking part of that premium, right? They're basically buying you term insurance to cover the death benefit. They're taking the rest of that money and they're investing that in units in a mutual fund. You would get to pick the mutual fund. You could change the mutual fund anytime you want, just like every other mutual fund strategy, right? If the mutual fund gains, you win. If the mutual fund loses money, you lost because you picked the investment strategy. The advantage here, I can get returns higher than that cap rate, but I also have to take on the risk that go along with that type of investing. Well, if I built my portfolio up inside of the insurance vehicle and say I have $1 million in cash value inside of the policy and my mutual fund returns 10% that year, I would have made $100,000 off of that policy contract that year, right? So those are the different types of permanent strategies, the advantages of the permanent strategies there. The biggest disadvantage in these strategies is life insurance policies are priced based upon age and health. So the younger you are, the less insurance costs you have in the contract. The younger you are, generally, the healthier you are. So the longer you wait, your lifestyle, if you smoke, all of these things create additional cost inside of the insurance strategy. So therefore, they might not be the best vehicle or the best tool for you to use from an accumulation standpoint. They're still a great tool for you to use from a legacy standpoint because the death benefit in your life insurance policy transfers to your beneficiaries tax-free. So I've got a $2 million policy. When I die, my family gets $2 million completely tax-free. It does not matter about my health. It does not matter about my age. If I make the premium payments, the insurance company is going to pay the death benefit. So the point of utilizing this tool or utilizing this strategy is, one, make sure that I create the freedom for my family. And number two, I want to utilize it in my overall portfolio to create financial freedom for myself, either through gains that are guaranteed or gains that are attached to an index, or actually investing my money directly in mutual fund unit strategy, right? So thank you for joining us today on this episode of Freedom Ain't Free, where we talked about where I died and I made my family rich, how to utilize the life insurance strategies for financial freedom. Once again, my name is Joel Huey. I am the principal at ARC Financial Strategies. We want to invite you to connect with us. We make sure that you subscribe, and then also make sure that you schedule a free consultation with one of our advisors. They'll give you your freedom number, how much money you need to save on a monthly basis for you to develop that $2 million portfolio. Thank you so much for joining us on today, and remember, freedom ain't free.